Hi, this is Randy Finney with Right Side of the Chart, and today is Wednesday, July 1st, 2020. What I want to do in this video is take a look at the agricultural commodities, those that stand out. So there's about, I'd say a little more than half a dozen. I'm going to go over those as well as some ETFs and ETNs that you can use to get a more of a blanket approach, if you will, more diversified, or you can go with the individual, trade individual commodities, or invest in them. And that's what I'm going to do in this video. I'm going to make the case that there's quite a few attractive swing trades there. The charts are bullish. We've gotten momentum lately going for the first time in a while. We have some upside momentum. We've had some buy signals triggered. And what this site is all about is I look for trade ideas. I provide analysis, tell you what I'm seeing, and then I'm constantly scouring the charts for the next trading opportunity and long-term investments as well, trend trades, things like that. Just the other day I was talking to somebody. He asked me, he said, Randy, where should I put my money? Where's the best place to make money right now? And I said, there aren't really many very attractive opportunities. We have different asset classes. So we have stocks, of course, and this is the S&P 500. What I'm going to do here is turn off all the lines and talk about that real quick. Now, in hindsight, this was one of the best places to make money in quite a while. We had one of the strongest rallies in years. In fact, we just finished the best quarter in a couple decades. I forget where the stats went back to, but quite a way, several decades actually. And that, of course, came on the heels of the worst quarter in since I don't know, half a century or more. And so it's all relative. You get a huge drop, the snapback rally is going to be a lot larger, and you have just expanded volatility. But let's talk about where to make money right now. A quick overview. We have different asset classes. Those are stocks or equities, ownership in a company. That's one asset class. Bonds are another asset class. Precious metals, consider their own. REITs are real estate, and commodities. So I'll rifle through these real quick and give you my thoughts. And this all ties into the fact there's just not a lot of attractive places right now. And there are points in time, not many points in history really, but this is one of those where there's just not a lot of attractive places to put your money. We've been in a over a decade-long period of artificially low interest rates. And so you can't even park it in the bank in a CD, get out of the market, in other words, like you could back in the at many points in time, 70s, 80s, early 90s, and all that. All right, so stocks. Let's talk about stocks. Well, the S&P 500 has had an impressive rally from low to high off the March lows. It was about 48% right there. You can see my pop-up box to the left. Now, the bulk of that rally occurred, I have this trading range that we hit right here. So the bulk of the rally occurred up until that trading range. In fact, so I'm going to do this is measure right to the high and go right here, that first peak in the trading range. And that tells me that of that rally, about 35% of it happened within just the first 1.2 months. So about 6 weeks there. And that's where the gains, most of the bulk of the gains were to be made. And I was clearly bullish down here and all along in the first part of the rally. Certainly, underestimated how far it would carry. But again, not by too much. The 200-day moving average and all these moving averages were key levels to be back tested. And so really from that point, it seems just because the market's hasn't gone down, like it's just exploding higher, and it hasn't. So from that point, there was less than 10% upside. And where we're at today, from where we peaked out, that first 35% run, the market's only up 5% from there. And you can see next to that on the bottom of the box to the left of the screen, that's been now 2.1 months, over 2 months, where it's not a complete sideways grind. It is an uplift, and who wouldn't take 5% on in this environment, low interest rate environment, in 2 months? But it's again not exactly a runaway market anymore. It was an explosive rally off the lows, the initial rally. We did have a nice lift once we broke out of the trading range, but as you can see here now, for the last 2 weeks, in fact 3 weeks, here we are. Remember the breakdown candle right here when we gap below the islands? That's about where we opened, exactly where we're trading today. Same level on today's candle. So there's 3 weeks where we've gone absolutely nowhere in a trading range. And now, okay, so that's what's happened, what's going forward. I still believe, as I've heard many people who I respect, people who have been in this business longer than I have, and say the same thing. This is about the worst, most abysmal risk-reward ratio in the stock market that I've seen. Some say they've seen in their entire career, which is longer than mine. But I remember the dot-com bubble, and I'll say we go back there and maybe we're on par. And the dot-com bubble was back in the early 90s, and you had it was mainly driven up by the Nasdaq, tech-heavy Nasdaq composite, similar to what's going on now. And there it is. There's the dot-com bubble. Now, the thing is, valuations like now were extreme back in 1998, especially 99, and they just kept getting richer and richer. So the thing about an overvalued market, in a disconnect to the fundamentals, it can go on and on and on. So when I say that the risk reward in the market is abysmal, in my opinion, it doesn't mean the market can't continue to climb. It just means that it does not look at all like an attractive place to be. And history shows us it probably won't. I don't think, who knows, could we see a 2000 a bubble blow off top again? It's possible. But again, there were a lot of different things going on back then. And I just want to point out too, that was followed by a nearly 80% drop that lasted for years in the Nasdaq composite there, when you got so extreme. And it almost looks similar to a blow off type top here, but again, this is a different market, different times. So back to what I was saying, we'll just rifle through there. Risk reward, where's the opportunities at? Well, I don't think it's here. In fact, I think the case can still be made that we are still in a bear market. Somebody mentioned the other day, the market's going up and divergences play out more because we're in an upturn. We're in a bull market still, and as long as that's true, bulls have the edge. Well, I don't agree with that statement. Hindsight, or looking back, 6, 8 months, a year from now, we might be able to say that was the case. But as of now, I did the math yesterday. The broad market, which is stock market, S&P 500, still 10% down below its previous top from the previous bull market back in February. So by no means is this are we still in the bull market that started back in March of 2000. And in fact, nobody can say that this isn't a bear market rally at this point just from where we're at. We've had a correction. We've retraced some, but not all of that correction. You call correction or whatever, that 36% drop into the March lows. The Dow's down 14%. Mid caps are down 16%. And small caps are down 18%. By the way, those guys topped back in mid 2018. They've been in a bear market and aren't anywhere close to taking out those previous highs. So again, by those metrics, you can't say that those are not in a bear market still, and this isn't a bear market rally. But that's semantics. Whether it's a bull bear market, whether you want to say it's that big drop that we had in the March lows was just a correction, if you will, within a larger bull trend. Again, time will tell. If the small caps and the mid caps and all the various indexes break out and take out those previous highs from either back in February with the large caps or going all the way back to the middle of 2018 on the small and mid caps. So, all right, so let's just, before we get into the charts of commodities, let's look at the other things out there. Bonds. So, okay, so should I maybe put my money in bonds right now? Again, one of the most awful risk-reward opportunities out there of anything right now. This is TLT. These are government bonds. First of all, you can see since the volatility, since the big meltdown back in March, government bonds have gone nowhere but sideways. Complete sideways trading range, TLT. And more important, again, does that mean that they can't go up over time? Well, let's take a look at this, TYX. These are long-term interest rates. These are the interest rates on the 30-year Treasury bond. And we're looking at a long-term chart here. Let me get rid of, let me squeeze these down a little bit, these indicators, and give us some room here. So what we're looking at here, we should go to a monthly chart. This is as far back as we can go. I can go back on this charting platform to the mid-70s. Pretty good there. We were in an upward trend. We had runaway inflation, high interest rates. So what you're looking at are bonds in reverse. These are the interest rates on the 10-year, on the 30-year Treasury bond, and you'll see similar when you look at the 10-year. And we have been in a secular bear market, is what it's called. Longer term, larger, clear bear market. There's our downtrend. And what happened here? This was 2008. This is where the Fed started distorting with the natural process, things I've talked about, the price discovery where buyers and sellers interact to determine rates. These are rounds of quantitative easing, artificial things that the Fed has done to interest rates to bring them down even further. Whereas this was the natural cycle. You had business cycles in the economy, recessions, contractions, but all along we were heading down. Now, what this is showing us, we're at the near bottom. As we all know, the Fed has taken rates, the short-term end of the curve, down to near at zero, and even the long-term rates not far from it. So what I can tell you, and I think anybody you talk to that's been doing this for a long time and understands how bonds work, short of negative interest rates, and Powell has adamantly said he will not go to negative rates, but I don't take anything the Fed says with any degree of I put a huge grain of salt. The Fed is reactive, not proactive. They don't know what they're going to do. The market dictates what they're going to do. They started talking about raising before. The market threw a hissy fit back in 2018, and they backed off, just as I said they would, and then went back to a more easy policy. And so you can almost predict what they're going to do based on what the markets do. They're going to throw everything they can at it. But here's the thing. They back themselves in a corner. Rates are at near zero. Again, this is the 10-year bond. You can see over the period of, when rates peaked back in the early 80s, down, 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 and again near zero. So where am I going with this? You have virtually no upside potential in the price of bonds. The only way the price of a bond goes up when interest rates fall, because the bonds are then more valuable because they're locked in at higher rates. And with near zero rates, at best case scenario, if you buy into a bond fund that holds 10, 20, 30-year bonds, whatever it is, 5-year bonds, at best you would hope that rates don't go up and stay flat and you collect what little interest they're paying. At worst, if we start to see inflation, or for whatever reason natural market forces begin to take rates up, foreign governments stop buying our bonds, they see that we're printing checks that we're not going to be able to cash, then rates can go up, and the risk is huge, in my opinion, on in the coming years on bonds. So it's only downside risk that I see, and I'm not talking slight. There could be a slight pullback in rates. I'm talking the bigger picture. So please understand that. I'm not saying rates can't go down a little bit more here in the bond funds that you have, or the individual bonds can go up a little. I'm talking bigger picture. You have virtually no upside capital appreciation potential on the bonds, and the rates are squat. So at best you hope that the bonds don't lose their value, that rates don't go up at all, and your bond fund or individual bonds continue to pay out what meager interest they're paying right now. All right, so hopefully I made at least my thoughts clear there. Gold's another asset class, could be considered. It's a precious metal. My thoughts on gold. Been bullish for years now and long this one, but I'm having my concerns lately. Gold broke out of that range that I talked about here on the daily chart, also on the futures, but it fell back below on the futures. We've got some pretty big negative divergences right now that are giving me pause, and I'm not liking what I'm seeing with these divergences. We're close to my final target on gold. I may even pull that target and close this trade out early. I'm talking about the long-term trade on gold that we've had for quite a while. So that's again another place to put your money, to be diversified. And there's that failed breakout I was yesterday, because the breakout on gold, and these are gold futures. Here's our multi-month trading range right there. It should be a box tool, but you know what I'm talking about, I think, because I've covered this quite a bit. Right there, and we broke out, and we did so with clear negative divergence on the indicators, and this is what happens when you fall back in. You don't just move down a little bit, it's impulsive. This is what we call a bull trap, false breakout, and when we fell back below there today, you can see gold fell hard, and it hit that trend line. Now, we probably bounce here. It's not the point of this video. I want to cover agricultural commodities. I believe we'll get a reaction off that trend line. It's not guaranteed. There's also some price support there. I'm going to give you a line. I had a little line drawn. I don't know if you can see it when I highlight it. It was on that little flag. So right about here, some decent support. But again, with that divergent high, there's a good shot we can break this trend line. That'll be the next sell signal, and that'll take us down there and possibly more, maybe even all the way back to the bottom of the range. So okay, there's another one, at least for right now today, because that's all I care about today, next week. as swing trading, where the opportunities in gold right now after today is looking a lot less hot than yesterday when it made that breakout above that trading range. And then finally, there's a couple other things you can put your money in. You can, buy real estate. Now, I can't comment on, rental properties and, buying your own apartments and duplexes and things like that. But what I can show you is what the REIT market looks like via IYR. It's one of the more popularly traded REIT ETFs. And same thing as a stock market. Everything had this kind of reinflation trade, oversold bounce off the lows. REITs rallied and went in a trading range a lot like the stock market because they are a component of the S&P 500. But as you can see recently, they've been going down. And when you look at where they've been, where they are right now, turn off all the lines. As of today, IYR is trading right where it was at the initial run-up. And that was 2.7 months ago. So if you had REITs, other than the very small dividends being kicked off this ETF, you've gone absolutely nowhere in about 3 months, and that's if you were lucky enough to catch that low off the bottom. And most people didn't. Most people bought in, and they figured it was safe to get back in the water here. Okay, a rather long segue into what I wanted to, the charts that I wanted to discuss, but again, at times I feel it's important to take a step back and look at the bigger picture, and not just how to make money trading, but how to where to put your money in your portfolio. And so the answer that I gave that the person asked me the other day, hey, where is a good place to make money? I said there aren't many. Right now, cash is certainly a good place. That person was inclined to maybe jump on, real estate properties, and when, if there's any opportunities in the near future. And there's always going to be opportunities in the stock market, but right now there aren't many attractive. But I'm going to go over those that I do see, and we're going to start out here with this one. Oh, one other thing, I'm talking about bonds. That the person I was talking to had mentioned they looked into TIPS, and they asked me about TIPS, which are Treasury inflation protected securities. Basically, they're government bonds that are benchmarked to inflation. So instead of having locked-in rates, and I wanted to hit on this because I just told you how bonds in general, I was talking about treasuries, which have fixed coupons, fixed interest rates, how they have abysmal risk reward profiles over the next 5, 10 plus years. But TIPS, on the other hand, they adjust the rates. So you say, okay, well, if we start to see inflation, then you're not going to lose principal as rates go up because these bonds are adjusted. So that helps to offset any drop in the bond price because the rates are adjustable. But here's your yields right now. These are the recent auctions. If you would have a year ago, back here in 2019, middle of 2019, bought into some TIPS. That's what the coupon rate here, but here's the interest rate that you would have got. I don't know if you can see what I'm doing. Next to nothing. About a year ago, that would have been your yield on it. Lately, these are the most recent auctions. You can buy a 5-year or 10-year TIP. They had a slightly positive, almost no interest, slightly positive coupon, but they must have came at above face value at the auction, resulting in a negative yield. So pretty much losing money right now on TIPS. And should inflation run away? Well, maybe at that point in time you want to jump into TIPS, but or not right now. At least I wouldn't. I'm not going to give the government my money for a negative return. So like I said, there's just that's the market, and you have to accept that and not try to squeeze water from a rock, blood from a stone. But where are there opportunities? All right, here we go. I'm going to go through the ag commodities in this order. I'm going to start with the grains. And grains are corn, wheat, and soybeans. In fact, I'm going to start out here with this ETF. I've covered it many times in the past. JJG. It's a one-size-fits-all if you want exposure to those three commodities. It tracks the price of corn, soybeans, and wheat. That's simple. I've been highlighting it. It's setting up in this bullish falling wedge. We broke out yesterday. That was your buy signal. We're following through pretty nice today. Very impulsive move up. And that's why I'm doing this video. I've seen, for weeks and even months now, I've talked about these charts setting up constructive. We had a divergent low here, started a run, but what happened is we got checked at the 50-day exponential moving average. You can probably see it here, that yellow line right here. checked at the 50-day. You can see the 50-day often acts as resistance when you're below it and support when you're underneath that level. Support, support, and then when it breaks, you can see the trend changes. So here's a level that you want to watch. There's the 50 was taken out there after the wedge breakout, and that's what happened today. So yesterday you took out the wedge, today you took out the 50, and that opens the door here. In fact, I was going to add this as an official trade as well this morning, but I started really bearing down in the charts on all these ag commodities I'm about to cover and show you right now. So official, unofficial, I've already given you my targets, and those are the three initial targets, and there may be additional targets depending on how the charts shape out. I just want to say it's a clear breakout, wash, rinse, repeat. Last time we had a divergent low in a breakout, we rallied 25%. So the time before, all said and done, we rallied about 12%. This time around, if we hit that third and final target zone, that'd be about a 20% return. So to me, this chart looks infinitely more constructive than the stock market right now. And again, it's all about risk reward. Doesn't guarantee it's going to play out. You know, you can just set a stop depending on where you took it. You know, set your stops in line with your price targets, or maybe a trend or longer term investment, and you're just going to scale in, gradually add to this position on strength, buy back on pullbacks to support, that kind of thing. And again, where your stops will be might be different from an active trader's. CORN, corn. Corn was recently a trade idea back a few months ago in April. We jumped the gun a little early, or I jumped the gun by putting that on. Needed to take out this trend line. That happened here. Stop was hit here, and I mentioned I still liked it all along. We had divergences building, broke out, and just recently corn's really started to take off. And note that volume down here. Look at all these volume bars. I don't know if you can make them out. We have some big volume, you know, in the last several week or two here. And more importantly, we took out the 1244 level today. That was resistance. See, we failed there before. It was support back here. And so these are the same targets. I've updated this recently. I have the same first targets. The trend line, expect a reaction there most likely. T2, T3, T4. Plenty of upside left on corn, I believe. If these charts play out, that would be about a 21% rally. Not by mere coincidence, that coincides with the target on JJG. Wheat, this one's an official trade, and wheat, you know, from where we're at now, if we hit T4, you're talking close to 20, about 18% from where we are from the lows. That would be right about that 20% mark. Wash, rinse, repeat. I already covered this one yesterday, so I don't need to spend a lot of time on it. And then soybeans. Soybeans I've also highlighted recently. Nice little wedge pattern breakout right here. There was your downtrend line right about here. Downtrend line, been building divergences for quite a while right there. And this line right here I'm going to take out. That was just if we were to, or still make another marginal new low, the divergences would be extended. But right now, soybeans, at least this ETF or ETN SOYB is right at resistance. We got to pop that 1419. That is the first target, but it was already hit once, and we tested again. So I suspect soon we'll break through, run up here 1474 trend line, and maybe continue to run from there. I wanted to point out something else too. You know, we have wheat as an official trade. Wheat and corn tend to move very closely. They're highly positively correlated, meaning they tend to, you know, one goes up, the other goes down, and vice versa. In fact, here they are. What I did, you can see corn is in yellow here. We're going back for years. Look at the bottom of this chart. Here's your time frame. We're going back into 2014 here. So if you can't see that correlation there, then I don't know what else to say. That's a strong positive correlation. Why is that? Well, they're alternative grains. You know, you can farmers can feed their livestock wheat. If wheat prices go high, then you can buy corn if it's a little cheaper. If corn prices are higher, you know, a lot of the same foods call for that. So they're also grown in the similar climates. You know, it's not like coffee, which is grown in, you know, tropical or subtropical regions. You know, wheat is grown in temperate regions. So you're going to have the same kind of impacts, you know, on seasonal extremes, drought, things like that. And so where I was going with that, not only do they both have constructive charts, but you can see corn now has rallied just in the last week or so here about 10%. And wheat's lagging a little bit behind, so there's probably a game of catch up to be played. We have about a 5% rally on wheat, which went into my thought process as well, and adding that as an official trade yesterday. Let's look at the futures for you futures traders. Now this is when I go to these charts here, you'll see these are from stockcharts.com, and they have what they call the continuous contract on the commodities. They don't give you real-time commodity or futures quotes or charts. They're all end-of-day charts, so it'll update after today about 5 o'clock. It doesn't matter, because what I'm trying to do here is paint the bigger picture. I can show you, I have other charts that are live streaming the futures, but I just want to paint the bigger picture and make the case for longer term trades. So let me pick a blue trend line here. Let me just playing with my drawing tools down below. Here we go, line. This is what I'm looking at. We have this divergence that's been building for a while here. We had a little divergent low right there and a little pop in corn back at the time. This is again a weekly chart showing weekly candles of corn futures, and all along we've been building these divergences. Got the RSI up top down here, and PPO on the bottom, RSI up top, and the corn prices in the middle here. But this is it. It's kind of in this basing pattern. It did just put in for the first time a divergent low. I've talked about corn for over last several years. This is S1, S2. This is a big support zone, these dashed lines. And it was resistance back here in the early 2000s. We hit the top of that level, had a reaction. You can see a lot of reactions on this level. So what I'm looking at is buying corn down at the bottom of decade. This is almost a decade plus, 15-year support zone. And I mentioned it at S1, and we did have some trades off S1, the first support level. And this is the bottom, what we call S2, the bottom of the support zone, we're recently hit and we're reversing off of. So that, coupled with positive divergence, oversold readings. Last time we were oversold was all the way back here, and there was certainly a trade to be made up to the top of this zone here, resistance zone, and that's it. So again, long-term case, and keep it very simple. It's all wash, rinse, repeat stuff. We have, let's see, let me grab, I'll use this line. We had divergent high here, correction, divergent high here, correction, divergent high here, correction, and divergent low, rally, divergent low, rally. So that's the bigger picture for corn. Here's my long term. This is decades going back to the late 90s of wheat futures. And plain and simple, wheat futures are and have been for quite some time in a bull market, an uptrend, a long-term uptrend. So let me just grab an arrow tool here and color that blue to change the colors from the dark backgrounds. This is your trend line right here, 2000 all the way up. And I've mentioned wheat several times. We pull back to the trend line. It's simple. This is technical analysis or trading 101. When you have a long-term trend line or support level, you want to buy pullbacks to that level with a stop somewhat below, and that's it. So that was the last time we hit it there. And sometimes you bounce along it and you continue to bounce, and then sometimes you just take off. Last time here we had a nice lift. There's been a few nice lifts off that level so far. So that's kind of the bigger picture using the weekly candle. And here's what wheat futures is what we look like here on the 60-minute time frame. We just put in a divergent low right here. We're coming off a divergent low. We have the potential makings of an uptrend line here to keep an eye on right there. We came back, pulled back to support today, both the trend line and that 489, 587. But most importantly is the fact we recently broke out right there. And that is above the top of that 492-ish resistance level. You had a gap right there and a breakout back test. So you can see the next targets in wheat. And again, corn starting to run, which should provide a tailwind for a long trade on wheat. Okay, and sugar still looking sweet to me. That one never gets old. And you can see here, this is a weekly chart of sugar futures right here. and you can trade it using SSG. Stay away from the ones that have the FF after. They've been retired. The companies retired some of those old. They still trade on the over-the-counter markets, but SSG or Kane are the two proxies if you want to use ETNs. I might have said ETFs there. They're ETNs, similar. And that's it. You can see here it's kind of a wash, rinse, repeat thing. You look for these divergent lows right there, and you get the rallies. Just in case, and these were all pointed out at the time. All these are previous annotations. Breakout. There was our BISA back test offering an objective long, and sugar can really run. You can get some nice lifts out of this. You know, that run right there. Off that divergent low, off support too, by the way, support zone, same support zone we bought it at back here, same support zone it just hit and reversed off here, but this run, to try to put it in perspective, that was a 140% run in fairly short order. So again, this is an attractive trading vehicle. I say this because someone on the site said, quit wasting your time with commodities, talk about stocks in the stock market. Like I said, I don't care what I trade. If it has a ticker and I can, with a few clicks of my mouse, buy or sell it, whether it's Bitcoin, whether it's futures, ETFs, individual stocks, that's where I go. So these commodities, I know they've been in a bear market for years now. They peaked back here, a lot of them, and have been in a bear market. But the rallies, these bear market rallies, are powerful, and sooner or later, all bear markets end, and then you start a bull trend. So I'm very open to the possibility that one of these trades we catch, and we did exit most of these. I've pointed out divergent highs, targets being hit, final targets, and we were able to step out in time and sidestep the givebacks. But I just want to say I'm very open to the possibilities that one of these can morph into a runner trade. And again, that 139% or so rally I point out, that was the last time we had divergence here on the RSI and PPO. I should say we had small divergence here, positive divergence, but that divergence has continued to build, and it's much larger now, setting the stage for an even larger rally from, well, this was really, that first rally was in 3 waves there. So this time around, we certainly have the potential to do a lot more than that. SGG was, we had an official trade where I stepped in a little early back there, and they have one day, they came through our stop, closed back above it the next day, and that was a little stop raid. But again, I mentioned that one looked even better here on the breakout, so I followed up on it at the time, said it still looked good, and it's run, I mean, since that bottom there. And again, we're talking, it stalled out a little bit like the stock market because it had a heck of a run. It ran up 32%, and then it's been moving sideways. We had this little uptrend line break, but it's been holding its own. It's been consolidating or correcting more in time than in price, really. This is a sideways trading range, little consolidation level. It's held this, I take that back. It was a successful trade. We hit our first target the very first day. T1 was 37. Then it went on to be stopped out. So whether you took profits there, it was successful. If you didn't take profits, or if you're holding out for T2, then it was a loss. Or you gave your own stop a little more room and you're still in it and you're back to, above where that first target was. So again, I just pointed out a constructive chart longer term. I just wanted to show you what the ETN looks like and where the next targets are. 40, 47, and then $47 would be the next targets on the ETN SGG. And the other one is Kane. They both have a decent amount of liquidity. Kane, I pointed out with this inverse head and shoulders pattern, which it's broken out from. You had your nice left shoulder right there, really 2 left shoulders, complex. Right shoulder here, and your neckline. You broke out, it was impulsive. It's been consolidating, working off the overbought conditions. It's had a nice run off the bottom. Again, these are, call it bear market rally, call it the beginning of a new bull market. It doesn't matter. Again, semantics. It's a 22% rally so far, and potential for more constructive charts, most importantly. So that's why I'm doing the video. And SB would be your sugar future. And I will skip the 60-minute chart of the futures. I already covered the continuous contract, the longer term on the daily chart there. JO, coffee, official trade, looking good. Breakout, again, I've covered this quite a bit recently since it's an official trade, but Simple stuff, it's down clean, nice clean downtrend line, big wedge pattern. We had a divergent low there. Keep buying it on this, around that 30-60 level. We had a little whipsaw false breakdown there, and it's bullish that we've regained it. Followed through. We broke above the R1 level, first resistance level today. We're above that 3162 level. That opens the door for T1 and ultimately I believe T2 and quite possibly more. So again, you look at long-term chart, this looks to be basing. Here, let me pull up a longer-term chart on the sugar futures. Rather coffee futures. All right, that's so what we're looking at here, kind of bigger picture stuff. This is a weekly chart of coffee futures, continuous contract. It trades well to the technicals. You get these downtrend lines. You get a divergent low, bullish divergence right there. Look for a breakout above the downtrend line or any other type of buy signal, and that started an uptrend. And you had a very well-defined trend line to keep you long, throughout there. And from top to bottom, just to show you, I love trading coffee. Yeah, again, the gains are much larger than the stock market when you catch these trends. That is, from high to low, that was about a 290% run. In fact, all the way up, let's just do it from the bottom to the top, right there, all the way to this high. That was the entire bull run in coffee, 628%, and that was from 2002 to 2011 right there. Obviously a correction in between there, but you were able to get out on that trend line break, maybe buy back in at that support level there. All right, let me turn off this measuring tool. But you can see, again, it's pretty simple stuff when you just take a look at the big picture. Divergent high. Now, you might say, oh, wow, that was a really small divergent high, Randy. When you have a near vertical trend line, you're not going to get big divergence like this. You're going to get small divergence, and it was clear negative divergence, and that was it. And then, boom, there was your sell signal. There was your get out of Dodge. That was a blow-off top, kind of like what the dot-com bubble was back in 2000 for the stock market, particularly the NASDAQ. And then when you're in those, they're great to be long, but you don't want to stay too late to the party because the ensuing correction is usually pretty strong. But it's wash, rinse, repeat. We set up with a divergent low, nice clean downtrend line, breakout, little flagging action to back test it, and then boom, divergent high. You get the picture. So where are we at? We came recently down here, divergent low, and we've been moving up. Back then I listed, this was my first target, laid out well in advance. Back here, I think on the break of this trend line, and we hit that. We got that from there. It was a 60% run in coffee, and my second target is still up at about 90% from back there, and I think that's what'll happen here soon in coffee. Okay, and this will be the last one. I'll cover one other commodity, ETN, after this, or ETF actually. But as far as the commodities that I'm watching right now, there are other ag commodities out there, but these are the ones that I'm really looking at. NIB, and on NIB, I'm going to turn off all the lines here because it looks pretty busy. At quick glance, it looks like we broke, and we did. At least on this chart, we broke this trend line right here, slightly below it, but not by a wide margin yet. And I'm going to show you the chart of the futures. So this is NIB, which is cocoa ETN. This weekly chart of cocoa isn't as hot because we had right here, we had a big divergent high. Now we had a heck of a correction, and here's a trend line. We went through it, we back tested, and we fell below. So I'm not crazy about that. However, it was a healthy correction. There is some minor support right there. You can see on that line we have a reaction high there, some reactions here, here. But last time we had a big divergent high like that on the weekly, there was a lot of downside left in cocoa. So that's a little concerning and tempers my my enthusiasm, if you will, on cocoa. But I did want to cover it because I do like what I see here on the daily chart. This is a daily time frame. Same thing. Cocoa futures, continuous contract, wash, rinse, repeat. You get these divergent lows, rally. Extension of that divergent low, and that put in the start of this whole bull run here. Again, try to put in perspective how much these commodities can run when they change trend. That was a 65% rally there in less than a year right there off that divergent low. Right here we had a divergent low that started this new uptrend here, and that was let's see if I can measure it up here from this point up to where we went. That's showing me that was about a 47% run from mid 2018 or late 2018 when we broke out to early 2020 there. And along the way, you can see the divergent highs that tell you if you're swing trading. Trend trader would just ride the trend as long as it's intact, whereas a swing trader might try to game these pullbacks, short, get out of longs, divergent high correction, divergent high correction, divergent high correction. But now we have divergent low. It's not confirmed. Need this PPO to turn back up. So what can happen here, and this is why I'm watching it, keeping it on my radar, we have support right here. We have another support zone here. In fact, these were targets. Way back here, I laid out the fact that these two lines might be hit, and they were both hit. We had a pullback to resistance with positive divergence. It gave us these two quick trades. So they were resistance levels and targets back then, and we've bounced off them before. We've had several reactions since. So what I'm looking at here is if we do get a little more downside, that might be it would be an objective long there, especially if we reverse off there, turn these PPOs back up, or we go ahead and we'd make another move down here to the bottom of the zone. So I'll keep an eye on cocoa for an objective entry, like I said. Preferably this one, because I think if we get traction on the rest of those commodities I talked about in this video, you'll probably see buyers come in and step in and start buying cocoa as well. But cocoa has very little, if anything, to do with wheat and corn. Again, grown in a different climate, used for different purposes. It's not an alternative or competing, commodity to wheat or corn or, soybeans for that matter. Now, what's also looking nice, and again, this is why I look not only at those ETNs, but I look at the futures, because the futures will sometimes, tell you a different story. You can see things you don't see on the ETNs because the futures are trading around the clock. This is CC. These are cocoa futures, and you had a divergent low right here. So your positive divergence building, and then boom, led to this sharp rally, and that divergence, the same divergence, has continued to build on the RSI, not on the PPO, because we just made a slightly newer low. Let me make sure this one's refreshed. But there it is. So you do have a divergent low right there. Need to kind of see some type of buy signal, because the divergence could continue to be extended or even burn through. But it's worth noting that could be the catalyst for a rally. Chart's not as clear right now as far as trying to identify targets and resistance levels, so I'm not going to spend a lot of time on cocoa, but I will keep it on my radar and let you know if I see anything that I like. And then finally, last but not least, I went through a lot of individual commodities. I showed you the futures contracts you can trade. I showed you the ETNs or ETFs. And then there's DBA, which is a one-size-fits-all commodity ETN for agricultural commodities. There's others out there, but they hold a lot of commodity ETNs. Not only hold crude oil and natural gas, but most that I've come across in the past are very, very heavily skewed towards that. So again, that's my experience. Most of them are out there that have it. And I can pick one for you here. Let me see. I have a couple on my watch list, but. Let's see. Yeah, here's one, GCC. It's got a good deal of energy in there, and it changes over time. And some others that I've seen have 60-70% or more in energy, and then very little in ag commodities. So I'm focusing right now on the ag commodities. And let's go back to DBA, which again is a pure play. I haven't updated these in a while. That will change over time, but you can see you have cattle, soybeans, sugar, corn, cocoa, wheat, coffee, hogs, feeder cattle, and cotton. You had live cattle and feeder cattle. Usually, but not always, when the grains are going up, it's putting pressure on the hogs and cattle, because that's a big input to the farmers. The grains to feed their livestock, and so keep that in mind. But it's a way to diversify. So sometimes maybe the grains are going down, the cattle are going up. It's going to smooth out the bumps in here. Case to buy DBA, just like back here. Last time we had a divergent low. Right there was only RSI divergence right here, you can see, but it led to this rally here. We had this downtrend line right here, a little falling wedge pattern. We broke out, We've been moving around sideways, put in a larger divergent low right here. So pretty powerful divergence in DBA. And I know I've been talking about it for a while, and it hasn't really gone anywhere. It's not going down, but it's not going up. But I'll tell you, I'm going to give you one more line. And it's simple. You want to watch those ag commodities, the ones I just covered, even if you only want to trade DBA. You say you don't have time to manage a half dozen different positions on various commodities. You would like the convenience of one size fits all. What you want to see is a breakout above about $13.90, maybe call it $14 to be safe, because I see this as a big, type of a consolidation zone right here, potential basing pattern right there in DBA. It's been building some energy, and it's these divergences that lean me towards this resolution of the pattern, as well as everything I just spent 30 minutes going over all those charts of the individual commodities which make up DBA. Leans me towards this outcome instead of this one. But like everything else, respect a downside break. If we were to break to the downside, you're still going to have divergence. So I might drop this one off my radar for the next couple weeks if we have a downside break, and then I may pop up again talking about DBA 2 months from now if we see some evidence of a bottom, if it does break to the downside. Not my preferred scenario, but until it breaks out of this range, it may continue to chop around a little. Again, one of the better looking asset classes, if you will, right now. Like I said, to me, it's all about downside risk and upside gain potential. I see gain potential if the commodities, even if they don't bottom here and start a new bull market, even a counter trend rally, I can see easily a rally back up to test this primary downtrend line right here in blue. And in DBA, that would be a 25% rally. I would put much better odds that DBA will go up 25% before it drops another 25%. But I would say the opposite on the stock market. I would say the next 25% from where we're at today in the stock market is most likely to the downside before the upside. And the thing about it, maybe I'll be right on one, wrong on the other, right on both. You spread it around, and again, you don't put everything in the stock market, you don't put everything into commodities, you don't put everything into gold. You spread it around a little bit, overweight the sectors you have the highest degree of confidence in, and underweight those or avoid those sectors that or asset classes that you don't have any clue as to where they're going. We'll wrap it up here. This has been Randy Finney with Right Side of the Chart. Hope you enjoyed it.